Okay, folks, welcome back. This is volume 2 of 3 for mastering high probability scalping. We're focusing on previous day bank liquidity runs. All right, so we'll be reviewing the daily bias so that everyone knows exactly what should be done. And I'm referring to a daily chart here. So when we're implementing the daily bias, what we're going to be doing is on the daily chart, we're going to be waiting for a swing high to form and to be broken. This will be bullish. Okay, when we see a swing high broken, in other words, a candle that has a lower high to the left of it and a lower high to the right of it, as seen here. Okay, if at any time in the future it's traded through, when we have that, we have a bullish stage. In other words, we anticipate a future buying opportunity. Doesn't mean to buy it right there. Just means we are now on an alert to wait for a specific criteria. Criteria is going to be looking for a swing low to form down here. Okay, a swing low again is a candle that has a higher low to the left of it and a higher low to the right of it, again on the daily chart. Key point here is this swing low should not take out a previous recent swing low. Okay, so if we have this criteria immediately after a swing high is broken, we have the probable optimal trade entry scenario by itself on a daily chart. Okay, doesn't mean it has to line up with a 62 to 79 tracing level. It just means that we are in effect trading with a higher low after breaking a short-term high. So we have a break in market structure, a retracement, so therefore the market should have an ability to find momentum on the upside. Okay. When the swing low forms, we're going to be anticipating the third candle, that is this one here, its high to be rated or traded through the very next day. So in other words, the next trading day where it opens, preferably you want to see it open below the third candle of the swing low's high. Okay, so here's your criterion. You want to see the swing low form without breaking a previous swing low immediately after a swing high is formed but breaking a previous swing high. Okay, so again, the stage for a bullish scenario is anytime a swing high is broken and traded to a new high, expect a retracement, wait for a daily swing low to form. The swing low should be a higher swing low than any recent previous short-term swing low. The third candle that makes the swing low, that high, you want to see the next candle open below that candle's high, and then anticipate the market to run through this candle's high. We're going to be looking for previous day's highs to be rated each day until a swing high on the daily forms or price reaches a key support or resistance level. And I'll give you an example what that would be. The immediate candle after this particular day's formation, we'd be looking for a bullish scenario, okay, either in the London or the New York scenario, to anticipate a raid on the previous day's high. The very next trading day, we would look for the same scenario again, looking for reasons to be bullish on a retracement lower, going higher, reaching for ultimately to this old high, because this would be an area of resistance, okay, or if it trades to that high and through it, we'd still maintain looking for bullish scenarios, buying, looking for previous day's highs to be taken out. Or if we have price rally up to a degree, either at this level or before it, and creating a swing high. Once that forms, we have to wait for that swing high to be broken on the upside. Okay, there's going to be a lot of missed opportunities, admittedly, with this, but it gives you a specific criterion to work within. Okay, implementing the daily bias. This is when it's bearish. You're going to be waiting again on the daily chart for a swing low on the daily to be broken. So we have a swing low here. Okay, again, a daily candle that has a higher low to the left of it and a higher low to the right of it. Eventually, as price trades through this break in market structure sets the stage for a bearish market condition. Okay, so we're kind of like alerted to waiting for a sell scenario. We wait for a retracement. When we get the daily swing high formed, the third candle here that makes a swing high, we're going to be anticipating that low to be violated the very next trading day. Key point is we don't want to see this swing high break a previous swing high immediately before the swing low that has broken a previous swing low. Okay, so what we're doing is we're looking for a swing low broken here. So now we have the ability to see the market trade to a new low. Then it retraces, but will not break a swing high. So now we're getting that 3/4 back retracement. Okay, so by itself, it's like an optimal trade entry. Doesn't have to be to 62 to 79% retracement level. It's better if it does, but it doesn't require it. You want to see the market trade up until it creates a daily swing high. When that third candle forms, at its close, very next trading day, you want to be watching for price to make an attempt to trade through this candle's low. And that remains the bias each trading day until a swing low forms, or we trade down to this old low, okay, or another significant low. So again, in summary, we're looking for a swing low to form on the daily chart, and then it be broken. Then we're looking for a swing high to form, but does not break a recent swing high. So here's our swing high, but doesn't come back to clear or break a previous swing high. When the swing high forms, we anticipate the third daily candle in the swing high right here. We look for its low to be rated or traded through the following day. And we look for the previous day's low to be rated each day until a new swing low on the daily forms or price reaches a key support resistance level. Now, you're not going to have a setup every single trading day. Okay, I've gotten a lot of emails so far since I've produced the first volume of this 3-part series, and the common complaint I'm getting is I'm not getting a setup every day, and it's not been promised. Okay, if you look at every major that's paired against the dollar, you can get about 3 to 4 solid setups per week. Now, that means that you're probably not going to get a setup every single trading day. Chances are one pair among all the ones that are available will provide you a setup to study so you can practice in your demo account with it. The emphasis is for you to remember that you'd only need about 25 pips or so per week. And if you risk 2% of your account, and that may be high, admittedly, for some of you, but if you have grown in your understanding about what I'm teaching and you're willing to risk 2%, it takes a little bit less than 25 pips per week to double your account or make 6% compounded monthly. And I think that's the objective that folks should be looking for when they're new, because it's realistic, it's low, but yet it still doubles the account over the course of a 12-month year. So if we're looking for one good setup that would yield that 25 pips or so, you only need one scalp, one setup that does that. Now, I started the current teaching week on Twitter, kind of like building the idea of making 50 pips per week. If you frame your scalps in such a way that it allows you to aim for 25 pips, you only really need 2 setups per week, don't you? Now, I like that model personally because it's very close to what I do as a short-term or intraday trader. I know the likelihood is I want to be trading on Tuesdays and Wednesdays. If I can get my entire weekly objective, which is 50 to 75 pips per week, if I can get that done in one day, then I won't do any more trading after that, regardless of what day of the week it is. But Usually I hone in on Tuesday and Wednesday because they're primarily the best days, whether bullish or bearish. If it's bullish for the week, then I'm looking for the weekly low to form around Tuesday or Wednesday's New York Open. If I can anticipate a lower close or weekly bearish candle, I'm shooting with an expectation that we're going to be seeing lower prices by Friday's close relative to Sunday's opening, then I'll be looking for Tuesday or Wednesday's price action to create the high of the week. So if I can trade in sync with that idea, it also formulates a lot more conviction and confidence behind the setups that I'm looking to trade, especially with what's being described here. It's a rather simplistic approach. It may have been an oversimplification on my part by way of creating this diagram, but from an internal standpoint, how I view the marketplace, this is what I'm looking for. Okay, so if I see it on the daily chart, chances are the daily chart will probably sustain the move for a few days, and you'll only need one trading day. Okay, so if you have a scenario that's bullish or bearish relative to what I just described here so far in this video, chances are you're probably going to have one day's worth of momentum, and that's all you need. So every single pair does not move lockstep to one another. They're not always moving in tandem. So what may be a good pair to trade today may not be a pair that's really good to trade tomorrow, but another pair may move in equal or better fashion. In other words, the setups are plenty, but you have to allow them to be presented in price action from the daily chart and then not forcing it. So let's take a look over at the charts, and I'll give you an example of what it looks like, and we can use the kill zones. Okay, we're looking at the cable. This is the daily chart. This scrolled through, just found a random place. It doesn't make a difference where we start at, but I want you to take a look at the price action here, and we're going to look at this swing low right here, and it's on the heels of a previous short-term high. Okay, so we have a short-term high here, lower high to the left, lower high to the right, highest high in the middle. It breaks that. Okay, so now we're on a buy watch for scalping. So this is a swing high that's broken, and we have to wait for a swing low to form after this is broken. So we're going to be anticipating a retracement after this run up. So as price starts to drop down, we have a preliminary swing low here. Okay, so this candle is the third one. We need to make sure we wait for price to trade through this candle's high. The very next day, it doesn't do that. Okay, then we have another candle form a potential swing low here. So this candle here, we have to wait for this candle's high to be traded through. Very next candle, it doesn't do it. It does it here. So now we can be a buyer here with a scalp running previous day's high, which is this one. Okay, so on July 24th, 2017, that high, again, coming in at 130.57, that's where the liquidity run is going to be right there. This candle on the 25th of July is where we'll be looking for the setup. Right there. Okay, and we're going to drop down into a smaller time frame. We'll use a 15-minute time frame. Okay, and I'll just scrunch this up, put the day dividers in so you guys can see it. So previous day's high is right here. So I'll put a horizontal line on the chart to facilitate that. Okay, so here's where the liquidity is. We're running for 30.57. Okay, this day here, we're looking for a scenario to get long to run that liquidity pool. And we have this, again, this is the liquidity pool we're reaching for, previous day's high on this trading day. When I use the market sessions, I'm looking for London setups and New York setups primarily. This is a London session low, and I'll let you see that here. That's in London. And we're going to use that, as I mentioned in volume 1. I use session highs and lows. And this is the highest portion of the day in terms of a 15-minute candle. Just put it right here. There you guys can see it. So I'm using this one and this one, framing the entire price move. So as price starts this day here, I'm not concerned about anything until it gets down into the optimal trade entry. 62% retracement level, respectively, 70.5 and 79%. Okay, you can see price trades it, hits it here. This candle comes in exactly 9:45. That's London. And we're going into a nice run into previous day's high. Okay, so you can see that was a nice little scalp. It offered as much as 10, 20, 30, 40 pips to get to the high, and if we look for 10 to 20 pips of a sweep above this high, that takes us 10, 20 here. So 20 pips, 40 pips, 60 pips, 70 pips or so in terms of potential price range. That in itself is it for the week for me. That would be it. I wouldn't need to do anything else. And it's hard to believe, but that's how I operate. I don't look for a whole lot of setups per week because I'm content with doing one thing well, and there it is. Now, if this were a more conservative approach, you could be looking for the long down here based on the optimal trade entry and reaching just to the old high. Now, if that's the case, say you're filled at, we'll just round it to 130.20. That again is getting out at 57. That's 37 pips or so. Okay, almost 40 pips. We'll just say 40 pips. You only need to do one more trade for the week for 10 pips to get a 50 pip net return for the week. Now, there's a lot of folks that will say, don't set targets, don't set goals for daily or weekly because you don't know what the market's going to do. Well, I would submit that that's partially true. We don't know with any assurity what the market's going to do, but we do have pretty strong probabilities of where the market may reach for. And if we can frame the idea of where we're trying to get in at based on time and price, kill zone, and specific optimal trade entry on price, and where we're reaching for, does that not offer us a definitive way of determining what could be reasonably expected for that particular setup? And if we know that we're looking at intraday setups like this, it's typically 5 days per week, unless it's a holiday or the markets are not trading because of some other bank holiday or whatever, we don't want to trade it. We can see many instances where 25 to 50 pips is rather easy to get. Now, it's when we get into the I want to make 250 to 500 pips per week, then it becomes a little daunting in terms of a task. So I think by focusing on 20-25 pips per setup and then aiming for 2 good ones per week, I think 50 pips is a really low-hanging fruit, reachable, achievable, and certainly realistic in the scope of a developing trader. Will you get it every week? No. Will you get it right out the gate starting using my concepts? No. But over time, you will eventually grow into that and that expectancy for a nice return of 50 pips per week. You can frame your entire career on that.